Welcome to BetterBooks with Kathy Houston. This training section discusses our fixed asset accounts. This is probably one of the more complicated accounts for most businesses to understand, but it's usually the easiest to clean up. So let's jump right into it. So what is a fixed asset? A fixed asset can be a tangible asset such as a building or equipment, vehicles, or it can be an intangible asset such as patents, copyrights, software, or goodwill. The type of fixed asset will determine whether the asset is depreciated or amortized. So why are fixed assets important? The first reason is that they can generate revenue. If you're a screen printer, it's hard to run a business without a printing press. The second reason is they can be used for collateral of loans. Secured loans, which are loans that were made against assets, are typically easier to acquire and have competitive rates compared to loans that are unsecured. Secure loans mean that if you don't pay that loan, then they can come and take that asset as collateral for your debt. The third reason is that assets can be liquidated for cash. If your printing press only prints 2 shirts at a time, you can sell it and purchase one that prints 8 shirts at a time. A fixed asset is added to your books by either buying it with cash or a loan, or by being contributed by a shareholder. When is a purchase such as furniture or office equipment a fixed asset versus an expense? Well, according to the IRS, if it has a useful life of 1 year or more and it is used in business operations, it is an asset. As of 2016, the expense has to exceed $2,500 per invoice or item to be an asset. If you write a check for the asset, code the transaction to the fixed asset account. If your chart of accounts does not already have an account assigned for the fixed asset, you will have to add it. Example, you purchase a new desk for your office in the amount of $3,500. You're going to go and add furniture and fixtures to your chart of accounts. The type of account is fixed assets. And then you're going to code your check to account furniture and fixtures. If you get a loan for the asset, you will follow these steps. Add loan to AAA furniture to your chart of accounts. The type of account is long-term liabilities because the loan period is 1 year or more. If it is 1 year or less, you would code it as a current liability. And then you're going to add the following journal entry. If you're a shareholder and this is your desk that you personally paid for, but you want to add it to your business, you would follow these steps. Add shareholder contributions to your chart of accounts. The type of account is equity. This account may already be in your chart of accounts, or it may be called partner contributions or contributed capital. These are some examples of fixed assets that are amortized: computer software, copyrights, patents, and goodwill. These are typically amortized, used in a straight line basis over the useful life of the asset. Depreciation or amortization, they're basically the same thing. One is used for tangible assets while the other one is used for intangible assets. The main difference for our purposes is that depreciation can be calculated at an accelerated basis, while amortization is calculated mostly on a straight line basis over the useful life of the intangible asset. Lucky for us, most tax software is going to calculate the depreciation and amortization for you. As we discussed in the previous slide, your tax software or your accountant will calculate your yearly depreciation and or amortization based on the asset's life, and your tax strategy. Most small businesses will use this general journal entry to post your depreciation at year end to match your tax return. So after you complete your tax return, this entry will be posted as a 1231 entry. Congratulations, all of your assets are clean. Now we're ready to move on to the liability section on our balance sheet.